John and the folks at the IIS have come up with a really cool idea here. John and I had brainstormed some things, and he's really run with this along with the help of the other great folks here. This is a pretty cool deal, and in the end, there's one goal. You don't have to be right. You don't have to be, the best M&A analyst out there. There's one goal. The same thing we did with the Student Investment Fund and with the pitch. By the way, Larry Chen, standing in the back there, was one of the first winners of the pitch, which was stock pitch contest. Larry was not only a winner, but he was too humble to accept the prize money. So he goes down in history. You don't want to do that. Save me money. But the goal here is to get you guys involved with something that's going to give you an advantage when you're out talking to people about jobs. If you meet up with somebody who's got a job and you say, hey, I'm a smart kid from Sac State and I study finance, okay, there's a lot of people out there that can probably say that. But if you have done something extracurricular, something a little different, said, hey, I did this analysis and it sort of put me on this path to look at this and some other parts of this industry, and this really interests me. I really like the semiconductor industry now because I did this project. And you can talk to people in that industry about your interests and your likes and dislikes. And I think once you get into it, you'll find out people are willing to talk to you. I'm amazed, constantly amazed at how little contact I get from students both here and at UC Berkeley. That I put myself out there. I speak at Berkeley 2 or 3 times a year, and I'm willing to talk. And Nader and John and the other guys here will tell you if you don't know. Nader, right there, also been involved. These guys were 2 of the only people who I threw out an invitation about a month ago to come to an investment conference in San Francisco, where there'd be 350 investment managers all milling around listening to companies give their pitch about what's going on. And they're the only 2 guys who took me up on it, which to me is crazy because it's the best stuff. They met a couple dozen people that day, which they made contact with, and they now are still in contact with. And my guess is all those contacts may ultimately help land these guys a job. And you can ask them about it, to get the true story. So we're going to talk about mergers and acquisitions and this challenge. I think John laid out the basics of it. But if I was sitting there in your chair, I'd be like, I have no idea what you're talking about. I went to school. I'm going to run through my background real quick. Because even a few years out of school, I was still pretty clueless about a lot of this stuff. I know when I did my accounting degree here in '85, I can't believe it was that long ago, but most of the talk of jobs and things was about you can work for it was Big 8, and then it became the Big 6 and the 5. I don't know whether it's like the Big 2 now, right? Big accounting firms. Or you might go work for the state of California or you might go work for the auditor, the state auditor, or something like that. Most of the time, people didn't talk about Wall Street. And ultimately, my career led me to Wall Street, and I thought, how come people at Sac State don't know about this? Because I guarantee you guys are as smart, as bright, as hardworking, as motivated as the kids that I've hired. Many jobs, I've people have worked for me from Princeton and Yale, and all the top schools in the world, and they're no different than you. The difference is they know the game. They kind of know what's out there. That's one of the things I've done through the years. I come up and I give discussions on Investing 101 and what's going on Wall Street. I used to do a presentation called From J Street to Wall Street. It's on somebody's website up here, and it sort of talks about the opportunities out there. Let me go through my background real quick. Again, '85 accounting. I went to work for Chevron Corporation in various financial and accounting roles, auditing roles, financial analysis, reserve analysis, which is an intricate part of the oil business. Left there after 8 years to go back to school, did my MBA full-time at UC Berkeley, and came out of there looking to get into, I wanted to invest. I wanted to be an investor. And it turned out that nobody really cared about a guy with 8 years of very specific oil and gas experience on the sort of generalist investing side. So I had to really decide I'm going to concentrate investing in a certain area. But first I've got to get more tools. And one of the ways I got more tools, I went into the investment banking world. My first stop was Coopers & Lybrand, which is a big consulting firm that has a financial advisory services group. And what they do is they consult with you on mergers and acquisitions. They say, okay, John, you want to buy, you're this desk company, you want to buy this binder company, great. We're going to go help you scrub it down, look at it, think about what the problems are, what the issues are, what you might want to pay for it. And I did that for about 4 months because I hated it. Consulting is a very tough life. They make you count for every 15 minutes of your time. And you're always trying to sell more services. it wasn't I didn't feel very value added. So I skipped over to a real investment banking job at Bank of America Securities, where I was helping middle market companies, think Easton Sports and Williams-Sonoma and Long's Drugs, people like that, when they were just looking to raise capital, usually $100 to $300 million. They wanted to build a plant or expand a distribution network or make a purchase of another company. Some of them were also recapitalizations. So, for example, John's 8 years old, the head of Easton Sports, and he said, my son's not going to take over the business. Somehow I need to get my money out. I need to sell something, but I want to retain an interest. We'd recapitalize it, put a bunch of debt on it, pay him out, and then the debt-laden company would then go on trying to pay off the debt. Sort of a leveraged buyout without changing all ownership. After that, I went to a firm called Off-Road Capital. 1990s were booming. It was the internet age, and every .com was coming out. And so I went to work for Off-Road Capital, and the specialty there was looking at very small companies looking to raise $5 to $10 million in sort of AEV round capital, early stage capital. And so there, instead of Bank of America, where I was really looking at financing big companies, it was picking winners. It was sitting down and talking to the management team and saying, how are you going to go after this, the pet food market with Pets.com or whatever the case is, and then picking the people we wanted to raise money for. In 2001, the phone rang, the NASDAQ had crashed, the investment banking world wasn't raising any money for .coms, and an old friend of mine who I had set up with a job many years before called me from Palo Alto Investors and said, Dave, you know the energy business, you know big finance, you know the banks, and you know how to pick management teams with a good plan. Those things integrate perfectly for us. We would like you to come and start a fund that invests in energy. So I finally got my dream job. So the reason I tell all this story is 2001, I was 39 years old, and I finally got my dream job. Okay? It's a very long-term, I would say be long-term greedy, right? Think about what you really want to do long-term, because it may take you a while. All along, these were good jobs, don't get me wrong. I did very well in all these jobs, but this is what I really wanted to do. And the tools that I was adding together really gave me the opportunity to do what I finally wanted to do. And that's one of my messages I always want to leave with you. One of the reasons I think this mergers and acquisitions thing is important, because it's one of those things that can add those tools. Hey, I did that. Yeah, I built a model, or I at least thought about it. I thought about strategy. I thought about, different companies. So I went to work for Palo Alto Investors in 2001. It was two other guys and myself, about $100 million under management. And I built that practice up to $1.7 billion over the following 9 years. That is one of the most successful and largest energy investment firms in the country. And I ended up basically selling the rest of my interest off to my partners, and I retired last year, and now I race cars and collect cars and coach lacrosse and hang out with my family and do things that old 49-year-old retired guys do, which really aren't interesting to you guys. But a highly rewarding and great career. All these careers are very rewarding, both internally as well as being able to feed the kids at the end of the day. So, who knows what an investment bank is? Because we've been saying that word. Anybody? What's an investment bank?
People want money. I want to grow it.
Okay, possibly. So that's more recent, actually. Most investment banks don't invest. So there's a buy side and a sell side. Anybody ever heard of those terms? Don't cheat. Buy side means security. People who purchase securities. Palo Alto Investors was a fund. People put money into the fund, like a mutual fund, right? And then we invest in companies. An investment bank generally doesn't invest, although Goldman Sachs and a few of the other guys started to invest on their own and trade on their own in the last 20 years. But traditionally, an investment bank raises money for people. So an investment bank doesn't invest their own stuff. They just say, hey, if you want to go public, you want to do an IPO and raise $200 million, I'll put together the security. I'll do all the legal documents. We'll get all the things signed off by the SEC. We'll package it up. And I'll go to the 200 David Andersons I know out there who each will put in $5 million, and we've got $100 million for you. Okay, that's what investment bank is, a conduit to money. The other thing they do is that same guy might say, I need to raise debt, right? I want to issue a bond, and okay, here's what the bond market looks like. I can get you $150 million at 8%, and it's got to be 20 years, and it's going to look like this. That's what investment banks do. And the third thing they do is mergers and acquisitions. because they have all that financing capability, they also say to you, you would go to them and say, hey, I'm looking to buy this other company, but I don't seem to have the money for it, but I don't have no debt. So if I bought this other company, what could the combined entity get in terms of new debt? You might say, his company's generating $10 million a year in profits, and my company's generating $20 million a year in profits. They say, okay, well, with $30 million in profits, we can probably get you, in the high yield market, we can get you 3 times that money, right? They'll give you 3 times your cash flow or your profitability in debt. So we'll raise you $100 million. So you come to me for 2 things: advice in what I should pay for his company, and advice on how to finance it. Does that make sense? Hopefully that's what investment banks do. So consulting firms like Coopers and Lybrand, other guys do the same thing. Other intermediaries might be brokers. If you want to sell your business, right? Let's say you own a heating and air conditioning business here in Sacramento. You've got 10 locations and 200 employees, and you're cranking out, you're building air conditioners for people. It's a great business. Well, how do you sell it? Often you go to a business broker. And so business brokers typically are intermediaries who have access and who know where the buyers are, or they know how to help you package it up. You're like, I've never sold anything. I've spent 20 years building my business. So intermediaries might be third-party brokers, business brokers. Attorneys, certainly lots of work for attorneys in the M&A space. There's a lot of legal documentation that goes with buying the company. And so M&A practices are fairly large within most legal firms. And a lot of the legal firms you hear about, if you ever are in the financial circles, Skadden Arps and O'Melveny and Myers and guys like that, all they do is securities law. So you hear people go, I want to go to law school. Well, you see the trial lawyers on TV. That's like 10% of the lawyers out there. Not securities lawyers are the people who are drafting documents this thick, prospectuses and things like that to sell securities. So if you want to be an attorney and do M&A, you can do that, although most of them I know are miserable. All the attorneys want to be investment bankers. See, attorneys get paid by the hour. This is one of the reasons I like investment banking. An attorney says, I'm going to work on this deal for you. It's a $500 million deal, and you're going to pay me $500 an hour for my service. Well, the only way I make a $100,000 fee is I work a lot of hours. The investment banker says, I'm going to sell your $200 million company, I'm going to take a 5% cut, $10 million. If I can sell it tomorrow, I work 3 hours, and I get a $10 million fee. Investment banking, this is one of the reasons I left consulting. Investment banking encourages you to be very efficient and very effective, whereas consulting and doing anything by the hour encourages you to draw things out. You ever notice, things always expand to take up the time you're allotted to do them? Same thing when you get paid by the hour. Corporate development is one a lot of people don't think about, but that's internal stuff. Anybody have a parent or family member working in, Intel or Siemens, for example, right? Larry, Siemens Corporation, big electronics and technology firm. They have people in corporate development. There's somebody in there whose job it is to spend every day, all day, thinking about who they can go buy. How can I go expand this firm? What's out there? So that's one of the things I'm going to encourage you guys to go find people. Find out who those people are, and you're going to get there generally through investor relations. Remember that word. Remember that word today. If you get involved in this thing, investor relations. Even if you don't get involved in the M&A deal here, remember this. In your investing life and your finance life, one of the best places to get information, whenever you want to know about a company, I think just call investor relations. You call the investor relations number for Intel today, and you can ask them anything. That's their job. Hey guys, your gross margins went down last quarter. Was there something going on in your Asian operations that made sense? Oh yeah, let me send you right up. Let me tell you about it. Hey, do you guys have a corporate development person that has been looking at some of the acquisitions? Oh yeah, okay, I can put you in touch with them. Now, if you're a money manager and you run $1 billion, they'll put you in touch with them in a second. If you're a student, they might not. But what I encourage all of you guys, especially if you get involved in this M&A thing, come up with a quick pitch. Right? Every one of you guys should be able to call me or any lawyer, any intermediary, any consulting firm, any investment banker, and say something like this. Hi, this is Dave Anderson. I'm a student at Sacramento State University. I'm participating in the Regional Merger and Acquisition Challenge that is part of the Institutional Investment Society here. It's encouraging students to look at mergers and acquisitions and some of the some of the ways we can enhance the knowledge of students about M&A here at the university. I'm just looking for 5 minutes of information from you. If you can talk to me about what you do in the business, if you can tell me your connection to X industry, it only takes 30 seconds. And if you say that 15 times, 10 people will say, I don't have time for you. 5 will say yes. 2 will end up being your best friend they might hire you. Who knows? You got to come up with that. I don't care what, whether it's this or something else, you got to have that kind of pattern. That's why the Student Investment Fund, I've told these guys, and John reiterated it nicely, it's one of the best excuses in the world. When I took these guys to the investment conference and I introduced them to CEOs and CFOs of multi-billion-dollar companies and said, hey, this is John, this is Nader. They're running money on behalf of the endowment of this California State University. Oh, you got my attention. You're a money. I mean, they're a money, for all intents and purposes, they're a money manager in that guy's eyes. And anytime you can get involved in something like that, it's more than just, I'm in a finance class. I'm working on a project. I'm doing something on behalf of the university. Well, that sounds a little more impressive, right? So that's what this is. That's what you've got a real opportunity to do here. And I cannot stress it enough. That's how you get jobs. That's how you get contacts. Kind of how I got my job at Chevron, but I won't go into that one right now. M&A arbitrage, private equity, those are other jobs. Arbitrage firms are investment firms that have money, and when mergers get announced, they are generally just trading around the differences in valuation. Your firm's going to get bought for $25. It's only trading in the market today at $24.50. You're basically betting on whether it's going to go through or not. Private equity companies are like venture firms or mutual funds, but all they do is go out and buy up private companies, tend to band them together, build them up, and then ultimately take them public or sell them off to somebody else. So there's a lot of careers in mergers and acquisitions. But everybody's different, right? And I put this slide up here and say, there's no one career path. If you had told me about that slide I put up about my career, for $1 million, I wouldn't have told you that would be my career path one day. You've got to sort of sometimes make it as you go along. Gain experience where you can, think long term, network. Help other people. I like helping people, and I've done it all my whole career, and sort of the cast your bread upon the waters thing. You never know what's going to come back to you. It was 1996 when a buddy of mine was highly unhappy at Bank of America Securities, and I knew this guy named Will Edwards down in Palo Alto who ran this little fund, $25 million. It wasn't very interesting to me, but I turned to my buddy Ted. I said, Ted, I got to introduce you to Will. I think you guys would get along. Ted ends up going to work for Will. Called me every month for the next 2 years, saying it was the greatest thing that ever happened. Thanks, and I should come work for him. I said, you guys aren't big enough, and it's not really right. Well, that's the call I got in 2001 while the market was crashing. I never put a resume out. That guy called me. Still thankful that I helped him find a job 5 years earlier. He said, Dave, come work for us. I'm telling you, it's a life changer, and it was. So you never know when that kind of stuff's going to help. So network, help people, cast your bread upon the waters kind of thing. Work for free. If you can get an opportunity here through the M&A thing or at the student investment fund, and you end up meeting somebody that you can say, hey, I just like to do a 3-week project for you. You put me to work, and I'll crunch numbers. I'll put together a spreadsheet. I'll compare. You're the CFO of Pete's Coffee. Happens to live near me in Danville. His son played lacrosse for me, and a great guy. Actually, CEO, I should say. And if you said to him, I've been doing this M&A thing, and I want to do something in the coffee world, and I'm going to put together a bunch of metrics on all these different coffee companies that might be interesting acquisitions for Pete's. Can I do that for you and present you with the results? Well, then later in your resume you say, presented an analysis of mergers, to Dave Anderson, CEO of Pete's Coffee. Okay, it's a true statement, right? And you didn't ask for a whole lot on either side of that. Create your own opportunities. This kind of thing allows you to do that. The last thing I'll say, if you do get interested in M&A, and John certainly has had some interest in this when we talked about it, but the best M&A people know an industry, right? I know the oil and gas industry better than probably anybody you'll ever meet, and I can do very well doing M&A in oil and gas. If you try to compete against me, being just a finance person, you wouldn't do that well, right? The best M&A people understand the guts of the food business or the electronics business. So go get some industry experience. If you really want to be a finance person, you want to be an investor, an investment banker, an M&A person, one of the best things you can do is, Larry and I have had this Dr. Larry Tim, has had several years now experience post-undergrad and recently finished his MBA, but he's got several years experience now with a high-quality electronic and technology company. And that, again, it may take you 15 years to get where you really want to get to, but getting industry experience will ultimately benefit you. And be patient. Someday you'll be old and you'll understand the value of patience. So let's talk about M&A. Why do companies do M&A? Some seek growth, right? They want to grow, and they got to say, I got to buy versus build. So does anybody remember Nations Bank? Anybody from Charlotte, North Carolina? Nobody remembers Nations Bank? Okay, old enough to remember Nations Bank. What happened to Nations Bank?
They bought out Bank of America and took the name.
There you go. Good man. He gets a star. Some people say, I don't know, they're gone. Well, they bought Bank of America. Well, they could have just tried to start building branches and adding offices and hiring people. They could just go buy Bank of America. Not only did they buy Bank of America, one of the things they found valuable in the name was the name. Bank of America had been around for 100 years. Nations Bank was 20 years and known pretty well in the Southeast, but not here on the West Coast. So Nations Bank bought B of A, took the name, kicked out most of the people, and made the business larger. So you can buy it yourself, you can buy it, or you can build it. And that's where M&A generally comes in. You might want to expand to new markets. You might want to eliminate a competitor. If you can't beat them, join them. Expanding to new markets might be, I'm Coca-Cola. Do I remember, does anybody remember Odwalla? You still drink Odwalla? Odwalla got bought by Coca-Cola. Why? Coke could probably make fruity, sparkly drinks from fresh fruit. Probably. They could probably figure it out. But really, those guys had the expertise. Because I'm just going to buy it. I'm going to expand into the fresh drink market because I think the soda market's kind of being hurt by the health food craze. So I want people who understand it, and I want a brand. That's often what you want, too. You want to buy a brand. And that's often why you want to eliminate a competitor. You see a really good company coming up, Intel looks over and sees this little company that's making these really fast chips, and they're cheaper, they're better, they're smarter. They go, those guys might kick my butt if I let them get bigger, but man, with about 1 week's cash flow, I can buy that whole company, and I'm going to go out and try to do that. And I'm going to give those guys a great deal, and they're going to come work for me, and they're going to get bigger. And that's something. Sometimes that's really what it is. It's utilize your existing infrastructure. I mentioned soda, right? That's often a good one. Food. If Natter here starts a company that makes healthy frozen burritos, and he's trying to get it on the shelves at Safeway, he's trying to get it on the shelves at Costco, it may be hard for him to do that. He can't get the shelf space. Well, but he's slowly getting more people to pay attention to it. And then Frito-Lay comes along, right? Frito-Lay owns Pepsi and all, Frito-Lay snack products. They get all the shelf space they want, right? They throw up the Doritos, whatever. They say, I can take your company that's selling $10 million a year right now and immediately put it in my distribution system. Just put 3 boxes on every truck I own, and you will immediately be in 50 new markets, which means your burrito company is more valuable to me. So you're making $10 million, but I'll pay you a ridiculous price, $100 million, right? You wouldn't make that in 10 years. You'll make it right now today with no risk. Why? Because I'm going to turn that into $1 billion company because I have a distribution network that makes it valuable. This is, as you guys think about companies you might do with M&A targets, think about that. Where you have a good little product that can be benefited by a distribution, whether it's a food company, could be who's got distribution network. I mean, it could be Starbucks has a distribution network in the fact that they have retail locations, or McDonald's, or it might just be Westinghouse has distribution, right? They distribute all their products into Sears stores and into Best Buys, and they have a distribution network. And if they just put your new Dave phone on the shelves of Best Buy, they're going to do better than you. Product expansion, customer expansion. In my investment career, there's a lot of companies that I did very well with. I invested in one little company called Superior Energy Services, and all they had was a set of boats. They had what's called a lift boat. It's a boat about 10 times the size of this room. It's a big flat platform, and you drive it out of the Gulf of Mexico, and then it's got 3 legs, and you start jacking those legs up, and that boat actually lifts off the water about 300 feet. And you know what you can do? You can service oil rigs with it. So all they were doing was basically using this for maintenance work. And they had the idea, they went, wait a minute, if I just put a coiled tubing rig on there, I could do well intervention. And if I just put a chemical injector on there, I could do. So they had a delivery system that could deliver more products. So they started going out and expanding by buying coiled tubing companies and chemical injectors and other things. And now, if you go to Superior Energy Services, they've grown from being a $100 million company to a $4 billion company in about 7 years just by pursuing this strategy. And they pay you 3 times your cash flow, and then they go find new customers. That's the other thing, customer expansion. I always invest in companies that could expand several different ways. I'm either going to take my existing product and sell it in new places, geographic expansion. I'm going to take my existing customers that I'm selling a single product to, frozen burritos, and now I'm going to sell them potato chips too, right? That's a product expansion. And customer expansion might be, I went into the East Coast with my burrito, and now the customers that I had in Texas, I've got new customers here. I'm going to expand to a whole new set of customers that never were in, maybe it's not Best Buy, maybe it's the East Coast version of Best Buy. I've got new stores to sell to. Railroads are a good customer expansion. I might own Burlington Northern, and I want to own Dave's Railroad, because Dave's Railroad is servicing all the coal miners in Pennsylvania. And that's a lot of railroad traffic. So I want to get into those customers, and I can't. If I buy them, I get into those customers. Now I can start selling those customers other products or other services. So those are just some of the ways you think about things you might want to look at. Let's speed through this real quick. Who's got a hobby, a passion? Anybody? Anybody? Something you do weekends when you're not here at school and I'm not boring you?
Golf.
Anybody? Golf? Good one. Any others?
Video games?
Video games? Good point.
Photography?
Photography? All great. So you guys should think about those things, right? Go with something you know when you do this. If you're into golf, okay, why should Nike maybe buy Callaway? Well, public companies, all the information's out there. Nike has golf brands, Callaway has golf brands. You might have the idea that, gee, Callaway, because you're a golfer, I don't know, I'm making all this crap up. You know, but here's my M&A pitch, you know, and I don't know anything about golf. Okay, I know about golf, and fill this cup right here. Callaway sells some of the most expensive drivers on the market. They use composite materials and some of the best manufacturing. They get the highest margins in the business, and some customers that only go with Callaway. Nike's trying to break into some markets. They've been paying all this money to certain people to take Nike, Tiger Woods or whoever they're using. If they put Callaway into the Nike distribution system, and Nike can sponsor more people and put more money at the Callaway brand, those high margin units will be able to exceed the sales of the low margin units that Nike's currently selling. Nike needs those higher margin products. Their average product margin is 20%. Callaway's is 30%. The more of those Callaway drivers you sell, the better Nike looks. Nike sells at a 25 PE ratio. Callaway sells at a 20 PE ratio. If you take those same Callaway sales and put them in Nike, they're worth more. Nike should buy Callaway at a 23 PE, a 20% premium over their existing market, and they're going to make a lot more money. It's going to be immediately accretive to their bottom line. Their earnings go up, and people perceive the company's better. There's my 30-second pitch. Okay, I don't know. Shoot, that's all. But that's the kind of thing you're looking for, right? Find a reason why somebody wants to buy it. Photography might be, Kodak. Right? Anybody read about Kodak lately? That was a brand. We had a great conversation the other day about assuming 5% growth into forever for like Apple, right? And people would have said that about Kodak 20 years ago. Kodak was the Apple of photography, right? And they're going to be there for 50 years of the greatest thing ever. Well, they're bankrupt. They're gone. What are they worth? Maybe somebody should buy Kodak. Maybe there's something in there. Maybe there's something in the brand. I don't know. Maybe Nikon wants to buy them because they have a particular technology. Maybe they just want the brand. They certainly don't want the film business. It's pretty much dead. Video games, there's tons of things, right? Electronic Arts is a manufacturer of games, a developer of games. There's a bunch of little guys out there. There's some Chinese online gaming companies that basically just sell, World of Warcraft at, a dime a minute to 10 billion, Chinese guys sitting in internet cafes in Shanghai. I mean, they really do that. They spend a lot of money on that, relatively. So, does that give you some ideas, some thoughts on that? So that's why companies do M&A. How to be successful? You got to pick the right target, right? Why buy a company and then screw it up? Nations Bank, gentleman back here. What's your name?
Brian.
Good memory on that. The other thing they bought at the time, they bought a company called Montgomery Securities, which was an investment bank in San Francisco. Bank of America then bought Robertson Stephens, which was the other big technology investment bank in San Francisco, and they're both competing. Well, they paid a couple $2 billion for Montgomery Securities. What is an investment bank? They've got a name, Montgomery Securities. They got about 100 really good employees who have great relationships with their clients, and they've got a history of doing good deals. Well, they bought Montgomery Securities, they dumped the name and renamed it Nations Bank Securities. They pissed off all the people in the investment banking group by saying, you're not going to work for Hugh McCall, who's this Yankee back in North Carolina, doesn't know squat about investment banking. And we don't like half your clients because we don't think they're any good. So what the hell did they buy? It's for $2 billion. Everybody left. The name was gone and all the relationships were torn up. Frankly, it was a failed merger. So you got to have the proper target, and you got to understand, some of the pitfalls. You should understand why. You'll hear the term due diligence. You got to do your due diligence. Due diligence is a term that came from the 1933 Securities Act that said, basically, we will hold you responsible for losing investor money as long as you went into it exercising proper and due diligence, doing enough investigation that people can't hold you responsible later. I didn't even think about that. I didn't think about what would happen at this. So you got to do that, or as an acquiring company, you can get in trouble. And then your integration has to be efficient. In fact, integration is, I've got his burrito company and his chip company, and I'm putting them together. I got two different management teams. I got two different styles. I got very different cultures. He kind of wears flip-flops in the office. These guys are buttoned down. Who's going to run it? How are we going to actually get your customer list over here? Integration in M&A is tough. Again, something that when you go up there to make your pitch, or you write up your thing, these are just things you need to know. You need to be careful about this. Callaway's offices are in San Diego, California. I called the investor relations group. They actually tell me they overlook the Pacific Ocean. Nike's in, Bohunk, Ohio, and nobody wants to work there, right? I mean, that's something you should know. That's a challenge, right? We need the SWOT analysis, what is SWOT? Opportunity, what is it? Very good, opportunity to test. And so that's one of those tests. Those is one of those issues, right, that you need to be thinking about. And those are part of the pitfalls. Pitfalls in M&A, you fail in integration. You reduce innovation, the people leave, you got cultural disparities. It ends up being too big to swallow. One of the companies I invested in, a little company called Alex Chalmers, went from $2 to, we put money in at $2 because they were needing $20 million to go make an acquisition. They did, very successful. They made another acquisition, another one. That company grew from $2 a share to $24 a share in less than 2 years. It was a very successful investment for us, but then they screwed up. They got a little greedy, and they went and picked one of the biggest oil field rental companies in the country, and it had been around for 100 years, and they went and bought it. And nobody there wanted to get bought. The employees were unhappy, and it was just too big. They just didn't understand just how big this company was. It had 400 locations. It rented drill pipe and drill collars and 18,000 esoteric SKUs in their rental fleet, and these guys didn't know how to handle it, and it totally screwed up. And at $22 to $24, a year later it was back at $4 because profits went down, people left the company, customers got pissed off. And then financing. You can screw up things on financing. You have to be able to finance it. There's how many trillions of dollars on corporate books right now? And there's a lot of big companies out there with cash in the books. So most of them don't have to do any big financing. But if you're Under Armour and you want to buy Callaway, you might not have all the cash that Nike has. So you can say, okay, I'm going to finance it. And one of the things you guys are probably going to want to do, very simply, is to ultimately build a model. We'll talk about this. We'll talk about that. Company A, Company B, sales, gross profit, G&A expenses, net income. Combine the two. Now, what they talk about are synergies. Okay, I already have a sales force. I don't need your sales. My potato chip sales force will sell your burritos. Therefore, all that's SG&A, that sales cost, that goes away. Because basically, we're going to fire all your sales guys. Really, what we're going to do is we're going to look at the 100 we have. You got 50, I got 50, and we're going to look at them, and there will be some attrition. We're going to keep 50 best people, right? Those, the kind word is synergies. Often it means, they're getting rid of redundancy, as the British call it. But you're going to want to build a model, so you're going to pull those two together. And so now Under Armour and Callaway come together, and you go, well, I want to pay $500 million for Under Armour. Well, I only have $100 million in cash. Where am I going to come up with the other $400 million? Okay, you put the two companies together, and you say between the two of them, they have cash flow of $300 million. That's how much they throw off every year. Well, if you do a little work and you look at what the debt markets are, I'm just going to here's the number. All you need to know: 3 times cash flow. That's about the max you're ever going to put debt on a company, whether it's through the bank or through issuing high yield bonds or what have you. But 3 times cash flow. And we can talk about these things, and I'd be happy to moderate in your Q&A thing. So you might say, Dave, how do I figure out what debt capacity is for Under Armour and Callaway? Okay, how much cash flow do they have combined? Once you take out the synergies and the redundancies, now they got $300 million. Okay, I think you can get $900 million of debt on that company. Oh, okay, that's cool. I only need $400 to buy them, right? So I'm going to go out and I'm going to issue $400 million in high yield bonds to finance this deal. It's no different than you guys buying a car or anything else. You're just saying, how much will they loan me? The bank or the public markets in debt. And those are basically the 2 places you're going to get money. You might find out that Under Armour, you read the 10Q and it says, we have an existing bank line with Bank America. Bank America has afforded us a $200 million bank line, of which we've only drawn $20 million. So they have availability of $180. Okay, well, maybe that's all I can pay for an acquisition. You start looking at what you want and then what you can afford, just like everything in life. So what can you finance? And generally, if you're acquiring a highly profitable, high cash flow company with no debt, do you think that helps you or hurts you? It helps, right? If you already look at a company that's got a lot of debt and it's had sort of, they made money in 2009, but 10 was bad. You know what? No one's going to loan you a lot of money on that company. So think about that when you're going after targets. Your first screen might be all companies in, I don't know, I like Columbia sportswear. I wear Columbia when I go skiing. Who's out there? I want to find, and I don't know if you guys have this, but what you want to find is a screening capability. I don't know, John, you might get up here when I'm done and talk about maybe that as a specific resource. What you want to find, where can I find out where all the public companies are in the sportswear business? And you should be able to go do that search. I know you can do that search probably on Yahoo, and I would tip, I have accounts at the Schwabs or the Fidelities of the world, and you can certainly do those. Or you might have a data system here, the S&P or who are some of the Russell. I was thinking, who's the the ratings agencies guys, Fitch's or whoever, Dun and Bradstreet or one of those. The library might have something that you can use for that. So you should find out about that. Specific financing pitfalls and things you should think about. Don't over leverage. Again, someone might give you $400 million in debt, but then you go, wow, that $300 million in cash flow we generated last year, that was a blockbuster year, and it was really driven by something. And the company's already sort of they said right there in their last press release, things are kind of weakening in Asia. I probably shouldn't take all the debt I can get. So think about not putting too much debt on a company. Understand accretion versus dilution. You should at least be able to, in your presentation, mention, I believe this is accretive. Does anybody know what that means? Anybody know what dilutive means? That's an easy one, right? Have your beer and pour water in it. That's dilutive. Same thing here. If I mentioned before, if I'm trading at 40 times earnings and he's trading at 20 times earnings, and I buy his company for 30 times earnings, and the next day we're together, and my earnings are now higher, and the stock market's still valuing me at 40 times earnings, then I'm gonna make money, right? It's accretive. It adds to my per share earnings. And basically, accretion versus dilution means when you put the two companies together, it's generally in a stock for stock deal. It's more important than in a cash deal. If I'm buying Ryan's company for stock, he's got 100 shares in his company, and I've got 100 shares, and mine are selling for $10 and his are selling for $1. So I'm a $100 company, he's a $10 company. I go offer him $20 for his company. He's basically, and I say, but I'm going to give you shares. So you're going to get 20% of all my shares. I'm going to issue more shares so that you have shares in my company, right? I had 100 shares to start with. I give you 20 more. I now have 120. What you now have to do is say, okay, wish these pens were there. If I have 100 shares, and I'm going to and I make $1 per share, right? I'm making $100. I make $1 per share, $100 per year, okay? And I go buy a company for $20, and that company's making $20 a year, right? So now I'm going to be making $120 a year. I've acquired that company, but what did I pay for them? I paid them. Let's see. I'm making $1 a share and I'm selling it 25 times, right? So my shares are selling for $25 a share and I've got 100 shares. So my firm is worth $2,500. Okay? But now I'm going to issue shares. They're selling at $25. Let's just say I'm going to give him $25. I'll give him 1 share. So it's 101 shares. Anyway, you just basically got to look and say, well, how many shares, if I divide the total amount by the number of shares, did the earnings per share go up? Or did they go down? My numbers aren't working here. But basically, you got to basically look and say, how much more money did I get at net income versus how many more shares do I have? Right? If I had to add 100 shares, so now there's 200 shares out there, right? But I'm only making $120. How much am I making per share? 60 cents. That would be a dilutive deal, right? I had to pay too many shares. Think about it this way. I have double the shares and only 20% more money at the bottom line. Does that make sense? Okay. If I had 20% more shares, it would be non-dilutive, non-accretive. If I added just 10% shares, so I only had to issue 110 or 10 shares, now it would be I'm making about 10 a share. Does that make sense? So that's the very basis of accretion versus dilution analysis. If you present a highly dilutive transaction to shareholders, they're going to say, WTF? Are you kidding me? What? I have a share right now that's making me $1. I own 1 share of the company, and it generates $1 for me. Why would I want you to then trade that for 1 share that gives me 60 cents? That's stupid. Shareholders will, if they have a vote, will vote that down. Shareholders, it's a big enough transaction, shareholders may have to vote on it. If it's accretive day one, without even having to expand into new markets, they'll love it. Sometimes it looks dilutive, and you say it's 60 cents. You go, wait, guys, I'm going to sell 10 times more burritos than you think, and it's going to be great stuff. We might think about putting a real quick dilution analysis or something up on the IIS website. So you got to look at relative valuations. You should at least mention, I'm a company selling for this, and I'm buying a company selling for that. Now, if you buy it for cash, you're just sitting there, and I've just got cash laying around, and it's not doing anything, and I buy a company with it, in that same analysis, did my shares go up? Did the number of shares I have go up? Anybody? Did the number, if I buy a company for cash, am I going to have more outstanding shares than when I started? No. I'm going to have the same number of shares. Are my earnings going to go up? Assuming the company has at least $1 of earnings, are my earnings going to go up? That's right. So a cash deal is always accretive. But if you're sitting there with cash on the books, someone might say, yeah, Dave, you're only worth $100, but you got $99 worth of cash. One of the reasons you're worth $100 is because all that cash sitting on your books. So cash deals are much easier. And so if you find a really high quality acquirer in your proposal, and they've got all cash, I mean, look for a guy with $1 billion worth of cash. Then go look for a company that's $500 million. It's going to make your analysis pretty easy. That's locked-in financing. I have the cash, or I have a bank line with $200 million. Right in the oil business, John Natter found out when I took him around. These guys talk a lot about the amount of debt capacity they have. But based on the oil in the ground, the bank will loan me $300 million. I haven't borrowed a single dime of it, but they'll loan it to me all day long because I have an asset in the ground. If I want to go buy something, I've got that $300 million. It's a line of credit. It's just waiting for me. So find out whether they've got that. All cash, stock for stock. And the other thing on deal is sometimes, one of the pitfalls is you overpay. Anybody know what an earnout or a clawback might be? Anybody want to make a guess what an earnout might be? I might say, okay, what's your name? Alicia. So I'm going to buy Alicia's technology company. And it's been growing like gangbusters, and you're doing well, but you know what? I'm not sure next year's going to be good, Alicia, so tell you what. I'm going to pay you $100 million for your company. But if buying that division, it goes up another 10% next year and it hits all its targets, I'll give you another $10 million. That's an earnout. That's saying, that's taking a little risk out of the price, right? What are you going to pay? Because that's one of the things you're going to talk about in your analysis. You're going to say, Under Armour should buy Callaway. Callaway is a $280 million market cap company, and I think they should offer them 30% more than the 280. It's whatever, $350 million. Buy $350 million and pay them cash. You might note in there, gee, Callaway was selling just a year ago at a much higher price. They are $500 million, so they might think they're worth more than 350. But the fact is, the market's telling them they're worth 280. You're giving them 350. Should be a good deal. But hey, Callaway, if I'm wrong, and it turns out your stuff is selling better than I think, and this is just a short trough you're in, I'll give you another $30 million next year. You can sort of use earnouts to do that. The other side is the clawback. It's the opposite. If it turns out every one of your sales guys quits on me, I'm going to take back $30 million because that's one of the reasons I'm buying. So you can sometimes get past the question of price, which is one of the issues we want to talk about. There's what Callaway wants, and there's what Under Armour's willing to pay. And they may be far apart. What's fair? Well, do a discounted cash flow analysis. You can do it real simply, right? With discounted cash flow analysis, you might just say, okay, Callaway is generating $30 million a year in cash flow right now. I think, let's just say they're going to grow, 10% a year for the next 3 years. So the cash flow is going to go 33, 37. Discount it back, use the 10% discount rate, and the discounted cash flow would suggest that it's worth $300 million. Okay, there's my price. I'm going to use a discount. It doesn't have to be fancy, guys. You only got a few minutes up there to explain it anyway. Okay? And that's about all you're going to do. Then you say, and by the way, Callaway, Nike bought 2 companies last year. Under Armour bought 1. Columbia Sportswear bought 2. And there were 3 others. And I found them all in, what's the deal? What's it called? The Deal. TheDeal.com. No, The Deal, which is a website you guys are going to have access to for 4 weeks, which has information on every merger and acquisition done in the United States. So you go in and you go, look, I want to find sports companies or whatever. And you find 5 of these companies, and they were all done at 8 times EBITDA or cash flow or whatever it is, right? However they want. And you go, okay, guys, I'm just offering you 10 times. So this is on a comparable basis. You're getting a deal that's very similar to what everybody else is getting in the market, right? I'm not screwing you. You're not screwing me. So public and private comparable transactions are big drivers. If you ever go to work, so by the way, if you go to school at Columbia University, you're undergrad, you're sitting in a finance class like this, and I ask you about an investment bank, every single kid knows what an investment bank is when they walk in the door. Why? Because they live in Manhattan. They know what investment bankers are. And they know that they drive really nice cars, and they know they live in the Hamptons and stuff. And so they go, I want to be an investment banker. So they can name every investment bank. And when you go to work, those kids from Columbia go to work for the investment bank, I guarantee what they will do for 2 years straight is comps. That's all they're going to do. VP will walk out at 6 at night. Go, okay, I'm going home. I got a presentation tomorrow. On my desk in the morning, I want every public comp in the last 5 years in the semiconductor business. I want a spreadsheet. I want this. And now that kid's going to work all night, and he's going to put together comps, which is just basically a spreadsheet of 15 companies and all their financial data and all their stuff that's ever happened in terms of trends. They're going to do this, but in great detail. So if you go and actually do some comparable analysis as you do this M&A deal, you've actually done some valid work that investment bankers and banks and intermediaries and all these potential hirers and internal companies. One of my friends is the head of corporate development for Cisco. Right? And all he does, he lives down in Danville, works down in Silicon Valley, and he all he does all day long is look at companies. And he hires younger people to sit there and run comps for him and look at companies and create spreadsheets and stuff. So again, it's valid stuff. So my price, your price, comps, cash flow, what makes sense? Now it gets down to negotiation. Maybe there's an earn-out, maybe there's a drawback. Gee, it's great that you're worth this much, but you're already over-levered. Gee, if I'm buying you at $30 million, but you know what? You are already sitting here with $100 million of debt on your books, right? Which means I've got to do something. I'm going to absorb that debt, right? When you put those two, I told you about putting your income statements together, right? Net income. Same thing, balance sheet, right? Cash goes to cash, debt goes to debt. You make one company from two. And you should basically do that for, that should be a basic analysis you do if you're presenting this up on the board somewhere. It's not really on John's template, but you at least ought to know what sort of top line, bottom line, and what you're going to get rid of in the middle. Like I said, am I going to save money on SG&A? Am I going to save money on distribution centers? Maybe whatever the item might be. So as you integrate, this is something I think you got. Is this in your template? Talking about integration, part of the SWOT. You should be able to say, from all I've gleaned and all I've read, Under Armour has a very young, very hip management team. They're into the professional athletes. Everybody knows them. They're cool. They got a great image. And if they go out and buy, Columbia Sportswear, we're really going to have to watch out for this. We know it's a challenge. They're a more staid, different kind of a company or whatever. So you got to be thinking about the Coke. Just mention it. Talk about it. What are the challenges? What are the opportunities? What are the core competencies? What is Odwalla good at that Coke isn't? What is what is Burlington Northern good at that Dave's Railroad is not good at? And then when you're done, Nations Bank and Bank of America, they fought for 6 months over who was in charge. And there was a big battle between Dave Coulter, who was the CEO of Bank of America Securities that I worked for, and Hugh McCall, who famously had on his desk a big crystal hand grenade. He was an ex-Marine. And if he ever handed you the hand grenade, that meant you were dead. So he handed that to Dave Coulter once, and he said, I'm going to run this place, you're gone. So you never want the crystal hand grenade. Modeling, I talked a little bit about that. Try to combine these two things at the very simplest level. Just take an Excel spreadsheet, go to the last 10Q, 10K of the company, the two companies, and again, very top, very high level. Column A, column B, put them together, and then is there going to be some more debt on the books because you're having to pay something out? Right? Generally, if I've got all cash, all you show is that the cash line, the combined cash line, then goes out the door. Or part cash, part debt. Or adding some new shares, because what you did was you had 100 shares outstanding in your acquirer, and they're going to issue 50 new shares. You just got to show it at the bottom line. That way, when you take the net income and divide it by the number of shares, it's a different number. Right? So, John, you might even think about having a half-an-hour session on that kind of stuff at some point. Who here is in Professor Howland's class? See what extra credit does? Thank you. I like him a lot. I've spoken to his classes in the past, and he might even allow us to do something like that in class. So where do you go? What do you do? And then I'm going to let you guys talk. I create a list. What are you passionate about? What do you know something about? What do you think you can get information on? Who do you think you might be able to call? Start thinking about companies and areas that you would really want to network with. If you say, I want to look at video game companies. That's pretty cool. Then, if nothing else, it gives me an excuse to call the investor relations guy at one of the top companies down in the valley that builds games. And I just want to talk to him about acquisitions he's done, or even 3 minutes on the phone with him. So pick something you can understand. Pick something you're passionate about. Read everything that the IAS has in their starter kit. There's 10 or 12 links in there that have some really good links on what mergers are about and what some of the issues are we talked about here. And then network, talk, ask, beg, whatever. Find people you can talk to, and I'm happy to try to point you guys. You say, do you know anybody in this space? Do you know anybody in that invests here? And 9 out of 10 times I'm going to say, no, I don't. I can't help you with that. But 1 out of 10 times, like, oh yeah, I know the guy at Cisco, or I can point you to a guy, that you can talk to. I'm hoping to get you, John, for a judge. This guy named Doug Gonzalez, who's a very experienced and successful M&A banker who now works for Think Equity. Used to be with, he was in Merrill Lynch, big M&A guy on the West Coast, and he's done more deals than you can shake a stick at. I'm hoping he'll have time to talk to you and maybe come up as a judge, and he'd also be a great guy to talk to.
Christopher Maya.
Did Chris hook you up with him?
Yeah, he's willing to do it.
That's great, and Chris will come up. So great people. I say here, make the most obvious choice regardless of price. So, if you say, look, Nike really doesn't have anywhere where it's got a $500 composite driver. And that's really something they need in their golf thing. They haven't been able to come up with the right design that people care. People don't want to pay $500 for Nike. It's just a different brand. It's like, why do you pay $30,000 for a Chevy and $150,000 for a Bentley? Why? It's a brand thing. And they both kind of go the same speed. One's nicer than the other, but in the end, there's a lot of brand in there, right? And so I'm saying make the right choice. If that's really the right thing, Nike really needs a high-end driver in their golf bag. Okay, great. Don't worry about the price. Come up, give your presentation, say, I think this is the right acquisition, but man, right now, where Callaway's price is, I'm looking at Nike's balance sheet, and I don't think they can afford it. It's too much debt. They don't have enough cash. It would be non-accretive. And you can make that. You can say, I think this is an acquisition they should make. I want to keep an eye on it. And I think if Callaway, has a couple of bad quarters, you can see their stock back down where a run coming from Nike would be good. I'd be perfectly happy with it. I don't know how the other judge would see it, but to me, that tells me you looked at something that you had interest in. You found a reason to call the guys at Callaway and Nike. And in the end, you came to a conclusion that, I'm not sure you should do this. But you should think about it, and maybe you should find it at another price. Now, that's really not the intent here. We're hoping you find one and actually make a presentation say you should buy Callaway. But if you get, 20 feet down the rabbit hole, that's okay. Don't say, oh crap, I should have done something else. Say, look, this just doesn't make a lot of sense. I like the acquisition, but I don't like the price. Whatever. You can say that. John, would you be okay with that?
Yeah.
So then determine if you can make it work. Look at where they're trading. These guys are trading at historic high, and maybe I don't want to pay up when they're trading. They're trading higher than they ever have in the last 5 years, and they're trading at 100 times earnings. I really can't make that make sense. My investors in my company might not like that. Look at other deal valuations. Go to the deal database, and ownership, concentrate ownership. I've been in deals. When I was an investor for Palo Alto Investors, we were often the largest investor in any given company. Right? So I might, because we invest in a lot of small cap companies, so I might put $40 million into a company that's got a $120 million market cap, which means I own 30% of the company, publicly traded, but nobody else owned anywhere near it. The next public investor might own 3% of the company. So we were the 800-pound gorilla. And if they try to make a deal they'd have to basically ask our permission, because they know that with 30% we could basically block that deal. We could find a way to block that deal, because we'd have to just go gather up some more votes and basically do a proxy fight and say we don't want it. So if there's highly concentrated ownership, look at the ownership. Yes, sir?
I want to ask you, when you said you invested in these small cap companies with the largest shares, did you have any problem with liquidating your money afterwards when you wanted to get out?
Yes.
How did that come out?
Well, we used to say that we invest in micro cap and small cap companies, and it's a great question, because liquidity. If I own 30% of a company, it's not like I can hit the button and go sell it today. It might take me months to get out. In a lot of those cases, it took me. Well, there was one that it probably took me a year and a half buying. Every time the stock would dip or something would, I'd buy it and I'd buy it and buy it. We became a pretty large owner. Generally, success breeds liquidity. So if I'm buying a company now that's only trading 100,000 shares a day, and it gets successful and earnings go up 10x, now it's trading 1 million shares a day, I got a better chance to sell more easily. There were too many 30% positions. I had a lot of 15% positions. And in a public market, when you're registered as we were with the SEC, you actually have to file a 13F or 13G that says, I now own 10. Once you go over 10%, you have to publicly state whether you're a passive investor or whether you're trying to force changes at the company, because they see 10% as sort of the point where you can start pushing your weight around. And so to answer your question, we always said you have to be right going in, because we have to do enough research up front to know that we're going to be right about where the company's going to be in 3 years. Because generally we invested for a 3 to 5 year horizon. We weren't investing in Intel today thinking it's 21 and it's going to go to 24 and then we're going to get out. I mean, that's not what we did. We invested in companies that we thought could go up 10x. I invested in Ultra Petroleum when it was $250 a share, and 3 years later it was $80 a share, and it was trading like water, right? And when I bought it, you could barely find 10,000 shares in a day, and it took months to establish our position. But success ultimately got the company to be, bigger, more profitable, etc.
So between the target day and the actual day, was there any drop in the profit margin, or was there an increase basically? The target day to get out, liquidating the money.
So that's a good question. Basically, it's not necessarily a merger question, but that's okay. It's an investing question. There were often times when I said it's time to get out, and I couldn't get out fast enough. And so liquidity was an issue. The company I mentioned before, Alice Chalmers, was one of those issues, and I couldn't get out quickly enough. Others created enough liquidity that actually sometimes you were better off. We talked about Flowtech, and you looked at the history of Flowtech, which was a company I discovered very early, and they had a chemical that would enhance oil and gas flow out of a well. So if you injected $10,000 with this chemical, month one you got $300,000 more of oil coming out. It sped up the recovery of. So it was very price insensitive. People would pay you they pay you $50,000 for that chemical to inject it, because they didn't care if they were going to get their money back real quickly as soon as they injected it into the well. And that company was hard to buy. But when they started increasing sales at 500% a quarter, and the stock started taking off, and it went from 8 to 30 to 50, and I had a $60 price target on it. I was like, this is worth $60, no doubt. This company's going to make a lot of money for a lot of years. And I started selling at 60, went to 70, finished selling at 70, then went to 80, went to 90. I was like, oh crap, I'm kicking myself. And then their quarter came out, like, well, we got to slow down. Things are, the market's getting a little hot, but people are getting a little too excited about our expectations. But next year, we're going to make $1 a share. Oh, wait a minute, we're going to make $1 a share, $90 a share. It's not 90 PE. CEO said it himself. Stock came back down to $30. So, I got liquidity when I needed it. Sometimes you get out too early, but usually it's better to get out too early than too late. So, the other thing, just side story, is, I unfortunately in 2008, when the market crashed, we had a lot of companies in our portfolio that over-levered, in companies where I owned 5 or 10 or 15% of the company, where my fund did. And that often puts you in a position that you got to do something. So we had a couple of companies where management was not treating shareholders very well. This is where M&A sometimes comes in, because sometimes you just need to get rid of management to make the company better. And in our case, there were a couple of companies where we went active. That's when we file a 13D and we say, we own 14% of this company, we're the largest shareholder, and we think change needs to happen. And if it doesn't happen, we're going to put up our own slate of directors at the next meeting, and those new slate of directors will be voted in by us and other people that are like-minded to us. And when we put in that new slate of directors, we're going to kick out the whole management team. Or, management team, you can do the right thing by shareholders and stop the stupid activity you've been doing, the private planes and the big parties, or whatever it is that they're doing wrong. Or you can sell the company because we think that's how you're gonna maximize value. So you'll hear about companies. Sometimes you'll pick up the Wall Street Journal and say, Kevorkian or somebody's so-and-so has established a 10% position. They're calling for change. They're going after a proxy fight. They're telling you need to change the company. It's sometimes known as agitation or activism, corporate activism. So I unfortunately I was the most active activist investor for about a year's period. I filed 5 13Bs, kicked out 3 management teams, kicked out 3 boards, reestablished them. In one case, it's doing very well. So Triangle Petroleum, which these guys met, actually ended up sticking 2 of my colleagues, the guys who were working for me at Palo Alto, in as CEO and CFO to run the company the way we damn well knew it should be run, because they had some great assets and opportunities. And that stock was 6 cents a share when we kicked out the old management team, and it's $6 now. So that's the kind of valuation improvement you can get by getting the right management team and then doing the right thing. So remember, if you get involved in this, and I encourage you to do so, it's a learning exercise. Just have fun with it. Don't worry about being right. Just do it. You know what? Submit something because it gives you an opportunity. If nothing else, if you say to me, gee, Dave, I really love a job in the software business. This at least will give me an opportunity to call up 3 software companies in the Valley and just say that thing. Hey, I'm Dave. I'm working on this project, blah, blah, blah. It's at least established a relationship with someone at a software company in the Valley. You have a reason to call them. And so don't worry about being right. Just use it as an opportunity to learn something, make a couple calls, call it networking practice. That's all it is. Doesn't cost you anything, and what the heck, you might be one of those 7 people. You might go spend a few days in San Francisco, and that's a pretty cool prize. I mean, you get to tour some firms and you really see kind of what's going on. Like I say, have fun with it, learn, and don't worry about being right. Just do something. So I kind of threw a lot of crap at you, but I didn't want to talk any more than that. So I can talk all that if I don't want to. Who thinks that they might want to actually submit an acquisition? That's great. That's great. I'd encourage much participation. And maybe, if you don't want to be the primary, but you want to work on something and help, maybe one of those people who does, and then people who doesn't, you get together. So, there's only one winner, though. There's only one prize. But that doesn't mean you couldn't, again, use it as an excuse. If you're one of those that didn't raise your hand, but you saw somebody who did, you go, hey, you know what, I'd make a couple calls, or I'd like to learn about that. Maybe I'll help with the model, or whatever. Find a reason to do something, because that's really what it's about. I think in the end, what you're going to stand up there and say is something like I said before. I think that Apple should purchase Motorola, because here's one. Isn't Google trying to buy Motorola? No, I'm so out of the tech world. I'm deep in the oil and gas business. So you want to talk to me about drilling wells in the Bakken Shale, or you want to talk about Utica Shale, or you want to talk about fracking wells? I'll talk all day. So Google Motorola, right? I mean, that's nothing like what I was talking about before. Who knows why Google wants to buy Motorola? What? Patents. Regarding moving data through the phone?
No, regarding, they're spending a lot of money on Android. They're spending a lot, Microsoft's actually getting a lot of royalties for every Android phone that gets sold. And Apple doesn't like Android. They're getting a whole lot of cash. So there's lawsuits going everywhere. So they're trying to protect their vendors who use the software to try to protect their own assets by being able to have it. So they're trying to acquire as many patents as possible.
They're also getting rid of a competitor. They're talking about, right? So that's great stuff. Though sometimes that's all you need. And Google's got so much cash. They can buy, if somebody's bugging them, go ahead and buy them. Right? Same thing for, Exxon. You've seen a lot of mergers in the oil business, Anybody heard of Brigham Exploration, that deal that just went down? Anybody besides you? If you don't know, Nader started a blog called sifenergy.blogspot.com. He's taken over doing some of the research that I showed him I did, and just looking at trends in oil and gas and demand and supply and pricing. And I encourage you to share that with people so they understand. You do a blog and you just write about stuff or follow something. A blog is a great way to sort of brand yourself, because you can send it to people. And I've sent his blog to guys I know in the business and say, hey, look at this kid at Sacs Dave who's doing this blog, and if you ever need any research work, contact me. Those kind of things are easy. I've done the same thing with John. I say, hey, here's a guy that's doing this M&A thing. He's really into the M&A side of things. I think he'd love to talk to you about it. Anything you can do like that is helpful. But yeah, that's interesting. Patents are another one. I don't know. That's a pretty esoteric, hard way to go figure something out. Who's got an industry that don't name names on companies you'd be interested in, but who's got an industry they think they might be interested in?
I don't know. I just was curious. Let's say the coconut water craze that's going on. Most of the companies that are in the coconut, I don't know if they work if they're private. It's just a new craze. I don't know how it would fit in, but.
Yeah. Coconut water. Who drinks coconut water?
I've actually been drinking a lot.
Really? I
Yes.
got to come back to campus. Really?
It's a new craze.
It's a new thing?
Yeah,
Yeah, so again, private. If you can get some information on private company, I think John said, the preference is to talk about a public company because you have more information on their financials. But again, it's a learning exercise. If it gave you an opportunity to call up the people at Waller or Coca-Cola just to ask a few questions about what they've seen in the coconut water craze and as they've responded to it, gives you a reason to call somebody. So I wouldn't discourage it just because it's private. It just means you're gonna have a tough time explaining the deal. How are you gonna price it? Well, these guys might be worth that. Anything about coffee companies? Anybody drink coffee? Ever think Starbucks might buy something? Starbucks is lots of cash. Starbucks is a great acquirer because everybody knows, you understand the business and you can talk about it. Anyway, anybody have questions? And you guys, come and go as you please. We're not holding you hostage. You guys can stay and chat, ask questions of John or me or anybody else. But
Before you guys take off, I would like to thank Dave for his time and his energy. You probably go for another 2 hours, probably. But anyways, thanks for coming out. If you guys want to stay and ask questions, please do. I did want to let you guys know to go to the website, check it out. The deal, which we've been talking about, is a service that we've actually got authorization for. They're allowing us to have a subscription for 4 weeks free during this process. So what I'll do is, if you are registering your company and you're interested, I'm going to submit your email and your name to the gentleman who's the sales rep. He's going to have a web training for everyone. And then if you can't make the web training, he can do individually. It's just kind of I'll show you how to set it up. And it's all about the mergers and acquisition deals that are going on every day, like 100 news stories every day they come out with, and database of all that history. And also, not just large companies, but small companies as well. So thanks again, Dave. And you guys want to read them?